here with Christopher Hall of Vestus, and we're discussing foreclosures. Now, everybody knows that there's very good deals in foreclosures, buying a foreclosed property at the auction. What we'd like to ask CH today, specifically, is what about the risks? Hi, CH.
Hey, Stefan. How you doing today?
Good. We know about the good deals at foreclosures, but what about the risks? I know there's a lot of mistakes that investors can make.
Well, you know, it's funny when we do a lot of these workshops and I'm talking in front of whether it's groups of 20 or as many as 300, it's kind of funny. Everybody has the same questions. Where's the auction? What liens and judgments follow the property, whatever. But, the biggest thing that I always try to tell people is that, there's 5 options when buying real estate. The safest is always going to be buying retail. Just regular retail with a regular real estate agent, going out and driving around in a car to your 10 favorite homes, and you're going to get everything you want. It's the safest way to buy. You're going to get the main level master. You're not going to buy on a freeway. You get a 7 to 10 day inspection. You get a 30-day finance contingency. You get a 60-day close. There's very little risk in that because you have so many outs and so many contingencies to protect you. But a lot of people say, I want a better deal. Well, along with the better deal comes more risks. So the second best way to get a property at a good deal is an REO.
Right.
Now, the REO just simply stands for real estate owned. It means it didn't sell in the open market. It didn't sell at foreclosure auction. It went back to the bank. They don't want it, but they're going to offer that at 85 cents on the dollar. So assuming that we're paying full price for retail right now, REOs, you're probably going to get it about 85 cents on the dollar. The thing about an REO is you still do get an inspection. They're just not going to fix anything. You're going to still get a finance contingency. You're still going to get a close date, so it's safe. It's just that the house is not going to be in great shape. The biggest risk of buying an REO is that they're not going to fix it up for you. You're going to take it pretty much as is, and that's why you get a deal. But again, the whole question is, what are the risks of buying foreclosures? And my answer is, the safeness starts with going regular retail, and then the next step is going to be REO.
Right.
The next safest, or I shouldn't say the next safest, the next best deal, but a little bit more risk, is doing a short sale. And the biggest risk in doing a short sale is that they take 5 to 10 months to complete, and there's a lot of paperwork. There's a risk that it might ever close, and on those you have to take pretty much as is as well. And going all the way down to the best deal, of course, is at the foreclosure auctions. So I answer this question a lot is, I almost laugh at the question, are there any risks in buying foreclosures? Well, there is the risk in the fact that we don't get an inspection. There is no escrow. We literally give them a cashier's check. They give us a receipt. You feel like you bought a t-shirt. The process itself is very, very safe. These are non-judicial trustee sales done with very experienced trustees. The paperwork is very consistent. We get a trustee's deed that gets converted to a warranty deed later. So the process itself is very safe, but we don't get an inspection. We buy these completely as is, and occasionally you're going to get a little bit of a surprise.
Okay, now for those just joining in, I just want to say that we're talking with Christopher Hall of Vestus. We're talking about what are the risks in buying a foreclosed property, and I think we're about to share a slide with everyone. So in case this video were to be split into 2 sections, here we are with the beginning of the next section for everyone. So go ahead.
Well, I think what you're going to show here is the slide that I use in the PowerPoint presentations when we do these, and I think I've titled it 7 Critical Mistakes Not to Make when buying foreclosures. And, one of these things that we talk about is, don't buy a property sight unseen. Know your exit strategy. There, I think it's coming up on the screen now. 7 critical mistakes you don't want to make when buying foreclosures. But I want to kind of keep talking a little bit about when people say, I want a really safe transaction. I think those people should buy regular retail. Those are going to be safe. One of the analogies that I use a lot is when people are buying stocks and bonds, you start out and you talk to your stockbroker and you say, you know, what is the safest way to buy stocks? They're going to tell you to buy mutual funds. They're going to tell you to, you know, you're going to get a very small return on your investment of 2 to 4% a year, and it's a long-term strategy, but it's very safe. And somebody would say, well, I want a better return on my stocks. Well, then you're going to buy maybe a regular stock. And somebody says, I want a better return. Well, maybe they're going to do an IPO, or they're going to do an option, like a call or a put. Now, a lot of people say, my gosh, I would never do options because I could lose all of my money. And I think the point of today's segment is along with risk is reward. Right. And along with risk is profit. And the more risk you kind of put out there, the more profit, you know, there's potential for that. And I think if people want to be completely safe, you know, maybe foreclosures are not always going to be for them and they should be retail buyers. Now, I will tell you, in the 12 years that we've been doing this and the 6,500 foreclosures we've bought, we very rarely get surprises. I mean, it's pretty consistent and seems pretty safe, but it is important that people realize when you buy the foreclosures, you don't get the inspection, and there's a few surprises that might happen.
Right. Now, one thing I've learned a long time ago with real estate is you can fix almost anything. Sure. I mean, if you're willing to realize the work that's involved and just do it, you can fix a foundation. You can fix water damage, really.
Well, and that's why that's why we're buying them at 65 to 75 cents on the dollar, is that some of these need work. By the way, some of them don't need work at all, and they're listed on the open market and they're in great shape. Yeah. We might get an occasional water and sewer lien, but anyway, I think that it's very much the same analogy as that when buying these, we know we're going to get a great deal, and if somebody said, is there any kind of a risk, I'd say those are the few.
Right. And so now I'm going to share that slide again. I think the first little bit there is about emotion. So let's see if I can pull that out. Do you see it?
I see it on my end.
Yeah, good.
Well, right. And I think it says don't buy, you know, when you're buying a house to live in, there's a lot of emotion. You're excited, you're driving around with a real estate agent, you can't wait, you're moving in, it's the American dream. When you're buying foreclosures, typically foreclosures are because you're going to buy, fix, and flip it, or you're going to buy it to keep it as a rental, and it's an investment decision. I mean, honestly, that's kind of where you leave your emotions at the door a little bit. I mean, it's still exciting, but it's a business decision. And you're going to be doing it based on, you know, your ROI, you're going to be doing it based on your yield, you're going to be doing it based on what you're buying the cents on the dollar, but it has to make financial sense. That's why we're buying these, is because they're a great investment. We're getting them at a discount. So when buying these, I think you do use less emotion for sure.
Right. Do you see number 2?
You'll have to help me with the second one. Yeah. It's hard for me to see the screen.
Yeah, it says don't assume. Do not assume there are no liens. Research the title. And I know Vestus does that on every property.
We do. We do title. We have an extremely strong relationship with First American Title. We let all of our investors know. We know it's a first mortgage. We're not going to let you buy a second or a third or a fourth mortgage. We know if there's back taxes. We know if there's IRS liens. We know if there's, you know, everybody I assume knows this. When you buy a property at the auction, you buy the first mortgage. The second and the third and all of the subordinate and junior liens go away. But there are a few liens that do follow the auction, and we let our clients know about that so there's no surprise. So mechanic liens will rarely follow. You know, certain things we know, child support, little things that are on title will never follow. There are a few that do, and we certainly let people know that before they buy them. Sure.
And so every week, Vestus pulls title reports on most of the properties, right?
On all of the properties.
All of them.
Well, because if we're going to buy them, we have to have the peace of mind that we know that you're buying a first mortgage, and we have to know what people are getting into. And so title is not a perfect art. There's a lot of moving parts to it, but, you know, after all of these years, you know, we're very thorough. We're very consistent.
Of course. And about the don't buy sight unseen, I know when I've done it, I've driven around and really looked at each property as much as I legally could, you know.
Right. Well, and we drive every single property, but quite frankly, sometimes they're occupied and we're not going to get inside each house. Sometimes we don't get right up to each one of them. I think our team's going to know if it has LP siding. They're going to know if it has a bad roof. Uh, 40% of these are listed and we can get inside because we're real estate agents and we can just get inside. Some of these are vacant, 30% are vacant, so we go around. We can see a lot more than we do. Sometimes they're open. But frankly, the 30% of these are occupied. There's homeowners living in them,
Right.
and we can't just knock on their door and say, "Hi, we're going to buy your property Friday at the auction. Do you mind if I just come look at the master bedroom?" And they're going to kick us right off the front porch. So
Sure.
a lot of our investors know that they're going to redo the kitchen and the bathroom and the carpet, paint, and appliances pretty much anyway. But for some of the new investors, if they're occupied and we haven't seen the inside, we might say that that's not the right property for them. So it really does depend on the investor, and again, kind of go back into that little bit of risk.
Right. So don't buy sight unseen, and let's look at the next one of 7. Don't pay too much. Buy at 25 to 45% off fair market value.
Well, the reason that I use this one is because if I'm going to get a better deal, stick to your guns. I mean, I find some people get so excited about buying a foreclosure. I just watched it happen at the auction about 3 weeks ago. They wanted something in downtown Bellevue, and he went, quite frankly, almost up to retail. And I thought, gosh, if I'm going to buy retail, I'm going to buy on the open market. The reason I'm going to the foreclosure auction is because I want the deal. I want that 65 to 75 cents on the dollar, or the 60 to 80 cents on the dollar, whatever it's going to be. But if I don't get a deal this week, I think it's better to just wait for the next week, because the good deals are going to come. So I tell people, don't pay too much. Get your strike price, stick to your guns. If somebody else is willing to pay more because they're going to live in it, or they're going to keep it long term, let them have it and wait for the next week. I think it's patience sometimes is worth it to get a better deal.
I agree, of course. Number 5, don't estimate value. Know the value.
I always laugh at this one because people always ask me, do you use Zillow and do you just go by assessed value? Or, right now Zillow is so far off of actual value because our values have gone so high and so low in the last couple of years. Assessed values are off. We have to do a CMA, a comparative market analysis that compares that property, all the properties around it within a quarter-mile radius that have sold in the last 60 days. We have to be very accurate on value. You have to know what short sales have sold around you. You have to know what REOs are for sale and have sold around you. And you have to know the accurate value. So I tell people, don't estimate the value, know your value going in.
Right. For those people just joining us, I just want to say we're talking with Christopher Hall of Vestus about the 7 mistakes you do not want to make when buying foreclosures. We're going to see the next and final 2 right now. I'm going to share that slide again now. And we're going to ask, what are the next 2? So we see the 5th one, don't estimate but actually know the value. And number 6, don't use gross profit, know all of the costs. What does that mean?
I think this is probably one of the biggest mistakes that I watch novice investors make, is they get really excited about, oh my gosh, I bought a $300,000 property for $212,000. That's 72 cents on the dollar, and I got this great deal. And what I tell them is I say, don't think about what your gross profit is. You have to think about what your net profit is. When you buy and fix and sell a property, or even when you're going to hold it, you have selling costs, you have holding costs, you have, repairs, you have, real estate fees, excise tax, title, and escrow. There's a lot. So I actually have a transaction worksheet that we go through that we kind of try to train people on. And what it is it breaks it down exactly that it's going to cost you 8% to sell. It's going to
Right.
cost you 5% to hold, and it breaks it down. And you know, I don't want to sit here and quote a percentage of what it would be, but the bottom line is that people should know what your net profit is at the end of the day, and just
Yeah.
don't do the gross profit.
And it's different for each property what that real number is, so you can't quote one number.
Absolutely. Well, the perfect example is if I'm going to buy and hold a property as a rental, I no longer have my 6% real estate fees. I don't have my 1.7% excise tax. I know not all states have excise tax. I'm not going to have, the same costs. If I'm going to keep it as a rental, I save some of those costs.
Sure.
The other thing, quite frankly, is if I'm going to flip a property, I'm probably going to do a major fix-up. If I'm going to hold on to that property, I'm probably going to do carpet, paint, appliances, and landscape, and that's it.
Right.
So you're absolutely right. Every situation is different depending on what that person's going to do with the property. But again, it comes down to know your net profit. It's kind of ironic. If I'm going to keep it as a rental and I'm going to do very little repair, that obviously allows me to pay more for it at the auction, and that's why every strike price is different.
It's interesting because what's not different is you do own the property no matter what happens, whereas
Sure.
in the options market, it can disappear on you.
Right.
Yeah.
And some of these people move into it. One of the things I find that's happening in the most popular areas, I just talked to an investor the other day that's in Atlanta. He says things are selling in 5 days. I talk to people in different markets, and just the market's good everywhere. For somebody that's going to live in some of these properties, gosh, they could go to 93 cents on the dollar and still make great sense of it because they're going to live in it. So again, their net profit, they're going to move into it. So it makes a lot more sense to go higher.
Okay, I agree. And number 7, don't be random. Know your exit strategy. I agree with that.
Yep. And I think this is an important one too. A lot of times people talk to me about if I buy, fix, and flip a property and I do it in 90 days, yay, that's going to be a great ROI. But you're also going to face short-term capital gains. Short-term capital gains are going to go right in as ordinary income, and you're going to pay taxes on it just like normal, whatever your tax bracket is. If you keep a property for a year and a day, you're going to go into long-term capital gains, which still for now is 15%. Depending on how much money you make, it could be higher, but long-term capital gains is 15%. And so when I say know your exit strategy, is if I'm going to buy and hold a property for a year, my exit strategy is what am I going to do with capital gains? Can I buy within a 1031 exchange? Can I buy a property at the auction and perform a 1031 exchange? The answer is yes. Can I buy a property within my IRA or my Roth or a 401k? The answer is yes.
Right.
So when I say know your exit strategy, know before you buy it. Am I going to flip it? Am I going to keep it? Am I going to move into it? And if I'm going to keep it, how long and what are the consequences? I think it makes a big difference on what you pay and how you're going to be accurate at the end.
Yeah, and on that keeping it for a year strategy, I just want to add that, doing carpet and paint when the tenant moves out before you sell it isn't all that expensive, really.
Right. Cost of doing business and cost of being a landlord, sure.
Yeah, and at that point you've profited for the whole year of rental. So that's a good strategy. There's a lot of good strategies. This has been fantastic talking with you today. Thanks for sharing all this information for free with all of us. That's what Vestus does. Gives us a lot of information for free. And then they serve their clients, their investors, right up to the moment they purchase and even until they sell that foreclosed property. Thanks a lot, CH, for helping us today.
Okay, Stefan, great to see you. See you next time.
Okay.